of what makes a great investor is literally just how well the investor understands the business, because that is going to affect the other half of what makes a great investor, which is making decisions, risk, understanding risk, and thinking when to get out, when to stay in, when to go deeper, when to pull the trigger, buy another 100 shares and another 100 shares and another 100 shares. Ladies and gentlemen, what's going on? Welcome back. My name is John. I got options. Today, I want to talk to you guys about 3 pitfalls to avoid as a beginner stock investor. So, if you're a young cat and you're just starting out on your stock investing journey, here are 3 pitfalls that you must avoid. First, start investing on a regular cadence. Start investing on a regular basis every week. Put money in. Do not go into investing thinking, oh, let me just put in $5,000. Let me just put in $10,000. There we go. I'm investing. That's not investing. Investing in stocks is when you put in a regular amount on a consistent basis. Every week, you put in a little bit. Every week, you're putting in money. Why is that so much more important than putting in a lump sum one time? Because when you put in that lump sum one time, you're going to be scared. You're going to operate in the market with fear, because you're going to think about that big chunk of money that you saved up for so long. It took you so much work, so much effort and time and energy to get that money. So you're going to treat it differently psychologically. 2, it's going to create this massive focal point in your investments as to the price of each stock you bought, because you're going to have bought your entire amount at one price at one time. So now you're going to be fixated on that one price for that stock. Every time it's below it, you're going to be thinking about, oh man, when am I going to get back to break even? Oh man, just once I make some money, then I'm going to sell it. See, it's messing you up psychologically. Messing you up, bro. But if you invest on a regular basis, you're going to build the position one brick at a time, right? You know, the kid who just stumbles upon a sandcastle somebody else built, they just crush it right away. You just stomp all over it. But the kid who built that sandcastle at the beach, he took his time. He's patting the walls down, making sure everything's nice and pretty. He took care of it because he had to go one scoop of sand at a time. But that same kid, if he starts walking down the beach and he sees somebody else's sandcastle, what's he doing? He's stomping on it. That's what you're going to do to your stocks. You're going to treat it differently when you just give in a big chunk of stocks. And that's kind of what it is when you just put in a big chunk of money in the market one time and you go buy a few stocks. You're going to treat it differently. You're not going to take care of it. Whereas when you just steadily just build up a position, you're going to think psychologically, you're going to think differently about the position when it's down. You say, no, you know what? It's a good company. Did my research. I got my conviction. I'm going to hold it. And you know what? I'm going to add a little more. Now's a good time to add a little more. So moving on to number 2. Investing in things you don't actually know. Don't do that. Just don't do that. If you don't know what the company does, actually know what the company does, don't do it. Don't buy. Why? Because investing in what you know, you are going to make the smartest decisions. You're going to make the best decisions when the stock's down and when the stock's up, when the stock's doing whatever the stock's going to do. Because you can't control that. All you can control is how you react to what the stock is doing. And to have the best reaction, you need to know what the business does. It's a business. A stock is a business. It's not just a number on a screen, bro. It's a business. And when you look at that number on the screen, that's just the price tag. Look at the market cap. Think about the market cap. Don't think about, oh, it's $98. No. Think, okay, it's trading at $6.5 billion. They're doing $1 billion a year in revenue. So they're trading at a little more than 6 times their revenue. That's how you need to think. What's the multiple to the sales, to the revenue? What's their multiple to their EPS? What's the multiple to the forward EPS, the forward sales? Okay? That's how you start thinking about your stocks like a business. Because then when you're looking at 98 on the screen, what does 98 even mean? I don't know. It's 98. Tomorrow it's 105. The next day it's 97. I don't know what's going on here. But when you think, oh, it's 98, it's at $6.5 billion market cap. Oh, now it's at 110, it's $7 billion market cap, whatever it is, whatever the math is. Now, the other side of investing in what you know is not just knowing the numbers on the business, but it's, do you know how the business even makes money? That is the essence right there. That's the essence. Half of what makes a great investor is literally just how well the investor understands the business. Because that is going to affect the other half of what makes a great investor, which is making decisions, risk, understanding risk, and thinking when to get out, when to stay in, when to go deeper, when to pull the trigger. Buy another 100 shares, and another 100 shares, and another 100 shares. The only way you're gonna have that conviction, though, to create that massive position is by knowing the business. Now, let's take Meta, for example. Everybody knows Meta. Everybody can wrap their head around the business, right? Have you ever bought something on Instagram from one of those ads? I know I have. I know most people have. And we all understand how Meta works. Advertisers want to sell their sunglasses, so they take some pictures, they do some marketing, they create an ad, and they go to Meta and they say, hey, I'll pay you to show this to people on Instagram. And Meta says, great. And then Meta's like, wait a minute, what if we make sure to show it to people that actually want sunglasses? Would you pay us more money? And the sunglass company's like, yeah, of course I would pay you more money. So Meta said, that's our business. We need to get really good at making sure we're showing ads to people that will actually buy that product, because the more they buy that product, then the more the sunglass company wants to spend with Meta. We all understand the business, and we all understand the different assets that Meta owns. They own Facebook, they own Instagram. I'm not even trying to chirp Meta. I mean, I like Meta right now. I think it's a good buy. But I just think it's a business we all know about, we all understand, we all can wrap our heads around. So now when the Meta stock goes down, and you're like, oh man, I bought it at 650, now it's at 600, what do I do? Are you really gonna panic? Because you have to zoom out. It's not a stock, it's a business. It's a business, it's a business. Zoom out, look at the business. Is the business growing? Are people using Instagram? Is Marky Zuckerberg doing the right thing with the capital? That's probably your biggest question, to be honest. Spending all this money on data centers and AI, okay? That's where the earnings calls come in. I love me some earnings calls. I love me some earnings calls. I love me some JP Morgan conferences too. Those meetings, all these companies have there's different conferences and whatever for different sectors of the market. And each of these companies send out the president or VP of whatever to go do a little spiel about the business, and you get nice little tidbits. Remember what I was talking about? You want to know about the business? Listening to those, that's gonna help you know about the business. Because not every business is like Meta. Not every business is that clear as day. And some businesses, I just don't understand. And the stocks go up, and I just don't understand. And that's okay, because I would rather buy a business that I really understand that might stay flat for 6 months, a year, 2 years, than I would buying a business that just goes up and I have no idea what they do. Because guess what? I don't know when to sell. I don't know, is this hype? Is this BS? I mean, I can look at the numbers and I can kind of see like, okay, I mean, I would think that this is a good value. It sounds like it's a good value. ChatGPT is telling me other businesses in this industry trade at this same valuation. But if I don't know what they do, as soon as it drops 10%, what do you think I'm doing? I'm out. I'm piecing. And that might be the wrong decision, because another person who actually knows that business, they say, no. Hold it. Buy more if it gets to this valuation. You know what? Actually, buy more a little bit now. So now that leaves me to the third pitfall that investors come to. Yes. The third pitfall. Beginner investors don't seem to understand what makes a stock go up. Actually. And I mean in the weighing machine. So you know the saying by Warren Buffett, in the short term it's a voting machine, in the long term it's a weighing machine. Well, what he's saying is that A company can tell a story, the markets can tell a story, the news can tell a story. They have a narrative right now. Right now that narrative is AI, and it's pumping all these chip companies. But I'm seeing some chip companies that I'm like, you know what? This is a great business, but it's not a good price. So in the weighing machine, for me, I think in 2-3 years, that same chip company might be exactly where it is today. It might go down 20%, it might go up 20%, but then in 2-3 years, it's right back at where it's been. So I lose 2-3 years of time. So I'm like, you know what? The valuation isn't right. I don't like the valuation. Maybe it is right. Maybe I'm wrong. That's fine. But there's other companies where I'm like, I like this valuation, and I'm confident this business is going to be 20, 30, 40% higher in 2-3 years. And that's what I mean by beginner investors don't understand what actually makes a stock go up in the long run. Because what actually makes a business go up is earnings and cash flow, free cash flow. That's what makes a business go up. And revenue. So you need revenue growth. Because without revenue growth, you really can only get so much free cash flow growth. Only so much, right? And free cash flow, that's the end all be all. That's where we end up, right? But the long term of the business is dependent upon that revenue growth. That's why you see these companies with really high revenue growth trading at these crazy valuations. Because the savvy investor is like, yeah, it's trading at crazy valuation, but I got in way long ago, so I'm not selling. So that just keeps the crazy valuation going a little longer because there's not much sellers. And then the last thing that makes a business go up in the long term in a weighing machine, the weighing machine, is buybacks. A company that is doing buybacks, and a little more specific than just buybacks, but share count reduction. Because a company could buy back 2% of their stock, and they could chirp that all day. Oh, we're buying back 2% of our stock. But if they're diluting 3% every year with stock-based compensation to their employees and directors and CEOs and COOs and CMOs and whatever, then guess what? You're being diluted 1% a year. Buy back 2%, but they're diluting 3%. Do the math. Basic. 1%. But if a business is buying back 3% of their stock and they're diluting 0.5% in stock-based compensation, well, now you have 2.5% share reduction. You want that the share count, the total share count outstanding to shrink. Why? Because that gives you a bigger piece of the pie without even buying more shares. For example, Warren Buffett with American Express. When he first bought into Amex, or when he was, whatever time period when he was first creating that Amex position, I think he had it at like 10%, somewhere like that. I don't know the exact numbers. And then after that initial accumulation of shares, he's like, all right, this is a good position. We own 10% of the entire business, right? He's a big shareholder of Amex. But he's held that position for so many years, and Amex has done so many buybacks and shrinking the share count buybacks that now I think he owns like 17% of Amex, and he hasn't bought a single share after that initial 10%. So he literally went from owning 10% of the business to owning 17% of the business just because so many years have gone by where every single year Amex is shrinking the total amount of shares. So if Warren Buffett owns this is the total shares, and Amex is like, we're shrinking. All of a sudden, your 10% is really 17% now. So he owns more and more of Amex's business, percentage-wise, every year without buying a single share. That's the power of buybacks. That is the company actually giving you the money. And that is the weighing machine of the business. And that's what I mean when I say beginner investors don't actually know how a stock actually goes up in the long run. Not just in this week and next week and, oh, this investor just came out and said that they have a position in this company, so the stock shoots up 5%. That's great, but that's all short term. That's noise. That's not signal. The signal is the revenue, the net income growth, the free cash flow growth, the earnings growth. Is the business growing? And then are they returning that money to the shareholders? Or are they investing in CapEx that's going to give a good return on invested capital? ROIC. That's where you look at someone like Tesla and you say, oh, this company doesn't do any buybacks, but they're their return on invested capital, they're building these factories. They're creating more, and they're growing into these new TAMs. Robotaxi, Optimus Bot, whatever it is. That might be a long play, though. And if you're not up for that, there's other companies. But that's just an example of where I see this company, this is the long-term weighing machine is going to play out. Not investment advice. None of this is investment advice. Don't take it as such. I'm not a financial advisor. Do your own research. Anyways, that's the video I got for you guys. Just wanted to rant a little bit about 3 pitfalls that I see beginner stock market investors make. Don't make those mistakes, or make them less because you watch this video. Stay healthy, stay wealthy. Make sure you comment below. Make sure you subscribe. Comment. I want some comments. I need comments, man. Comments get views. Share this with a friend. And check out feedmetrades.com if you want to track your options trading journey. Stay healthy, stay wealthy, and stay tuned for the next one. Peace.